but 19-fold. This would be, this is, a magnitude earthquake we have never seen.
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
How do you feel about the outlook for the labor market? Do you think this is the path towards mass unemployment, or do you think that this is a path towards just greater productivity?
Well, we think that technology net is a job creator, net. Think about of all the jobs created as we automated the farm, right? Think about how much the world has changed. And in fact, in the early 1900s, people were worried that tractors were going to throw people out of work. Well, much of this labor was free. It was children. Families were running these farms, and the children were working for free. This opened up those children to leave the farm and become a part of the Industrial Revolution. Now, with robotics and artificial intelligence, we're going to see manual, and some people would say menial labor, converted into much better jobs. Now, is there some displacement in the short term? Yes. And we believe that corporations and schools are going to have to retrain people as these technologies evolve. But, there's a lot of do-it-yourself learning. This is a completely new area, and you can get on the right side of change and ride some exponential growth curve. So I think it's a very exciting time for people who want to move onto the right side of change, want to, harness incredible opportunities being created by technology. I think it's going to be the most fertile time for people to determine their own success by embracing and learning and becoming a voracious learner about these new technologies. Last year was a terrible year for crypto. But why was it such a bad year? The first reason was algorithmic stable coins. We didn't believe in those at all. They weren't rules-based. And so that was the Terra Luna fiasco. So you have to do your research in this space and not try to ride a dream of some sorts. But then if you look at Celsius, 3AC, FTX, all of them went bankrupt. Why? They were centralized and opaque, not transparent at all. In fact, Sam Bankman-Fried, so SBF, as everyone came to know him, he didn't even like Bitcoin. Why not? Bitcoin is totally decentralized, completely transparent, and auditable. He couldn't control it. And of course, he thought he was a master of the universe. So Bitcoin actually, and Ether, neither Bitcoin nor Ethereum, those two networks skipped a beat throughout all of those controversies. All of the transactions cleared, all of the margin calls that were a part of smart contract, they were satisfied. So actually those crises proved the concept. Now we come to the banking crisis this year. Just think about what a proof of concept this is. The decentralized, transparent, audible networks didn't skip a beat. And here we had, stocks halted in the stock market, in the regional banking space, because there were bank runs taking place. That of course was not happening on these decentralized networks. And so I think that, as you say, digital gold has now gained even more credibility. It came out of the last crisis. The 08-09 crisis is when Bitcoin emerged. And it took another crisis for others to understand, oh, wow, maybe our banking system isn't as safe as I thought it was. And maybe I need a hedge against that. Bitcoin is a very good hedge. It's a great insurance policy.
You pointed to the analog of the current banking system. And we saw a bank run on Silicon Valley Bank. We saw deposit withdrawals from First Republic because there was a crisis of confidence, because there was a herd mentality and then a herd rush that impacted those financial institutions. We have seen with Bitcoin, we have seen with crypto, confidence rupture at points over the last 24 months. And as a result, the price come down dramatically. So even though it's decentralized, do you think it's still immune from animal spirits?
I think it is an anti-fragile asset, and every one of these crises strengthens it. The network becomes stronger and healthier, and we have metrics to manage that. The price is extremely volatile, as is the case with most innovations and new technologies in their early days. There's a lot of uncertainty. Why? And this is a perfect example. There's the old guard, and they're trying to say, we're going to wipe this innovation off the face of the earth. It has no reason to exist. And the innovation just gets stronger and stronger and stronger with time. And if you look at the measurements of the health of the network, the Bitcoin network, the Ethereum network, their health has actually improved through all of this turmoil. So that's essentially what I would say. And we think that crypto is three revolutions in one. One is the money revolution, which is what we're talking about here when we talk about Bitcoin. And that could be the biggest of the revolutions. The first global private, no government interference, a digital rules-based monetary policy with no central point of failure. Who knew Silicon Valley Bank was going to be a central point of failure? Nobody. It's shocking. But I will tell you, just in terms of setting this up a bit, the second revolution, let me do this first. Second revolution is a financial services revolution. And that's called DeFi. Many people call it DeFi. Ethereum is the network most used for this. Chris Berniski, who was our first analyst, would like to name it the Internet Financial Services Revolution. That way more people will understand it. DeFi sounds gimmicky, and I agree that might be so. But we do think that it's going to revolutionize financial services and collapse the cost. And then the third revolution, Web3, metaverse, is effectively, for the first time, digital property rights. That's a big idea too. So we think that crypto, the entire ecosystem, is going to appreciate from $1 trillion today, and Bitcoin's just a little less than half of that, to $25 trillion by 2030. These are very big ideas. Now, to get to the economics part of this, the reason we're going through this crisis is two serious mistaken assumptions that banks and bank examiners have made, and also that the Fed has made. The first is that interest rates, after we went through COVID and we were worrying about a depression, banks said they were flooded with cash from the stimulus programs. And so banks put it to work in long-term interest rates, which at the time were only really 1.5%, because they thought the economy was going to be shut down for a very long time. And the Fed told them that it thought that the economy was going to be down and out for quite a while. So they put money into securities at 1.5%, and never dreaming that the Fed would raise interest rates by 19-fold in 1 year. Well, that happened. That has never happened in history. In fact, the biggest increase that we have seen in a short period of time was twofold back in the early 80s under Fed Chairman Volcker, when he was trying to strangle inflation. but 19-fold. This would be, this is, a magnitude earthquake we have never seen. The economic measures that the Fed is basing its policies on are old. They're based in the industrial age, and they get revised in major ways as technology begins to inform them that, wait a minute, we're not measuring this correctly. And so we think they've been relying on lagging indicators, huge lagging indicators, and ignoring the data. And I'll give you the data, and then I'll tell you the second mistake that was made. The data was in spring of 2022, credit default swaps on banks in the banking system started moving up, and they kept moving up all year. The Fed ignored that. That was starting in January of last year and intensifying through the spring and lasted through most of last year. The second thing they ignored was the yield curve, which inverted in July. An inversion of the yield curve. And so to explain that, typically long rates are above short rates.
Yep.
July of last year, long rates fell below short rates. That is a signal to the Fed that the economy is either going to slow down rapidly and end up in recession, or that inflation is going to be much lower than expected, or both. They ignored that. I wrote a letter, an open letter to the Fed last year in October saying, respectfully, I don't understand why you are raising interest rates by 75 basis points at a clip when we've got conflicting evidence and you're voting unanimously. What about credit default swaps? What about the inverted yield curve? What about commodity prices coming down? Oil price peaked last March, April at $130. By the end of the year, it was near $70. The Fed ignored that. And it ignored what companies were saying as they were reporting earnings. So they ignored so many things. So I fault them very directly. And the other thing, the other mistake people made, and regulators fed everyone, was never dreaming that deposits would leave the banking system. We have not had a decline in money growth on a year-over-year basis since the Great Depression of the 1930s. Money growth is negative year-over-year right now. And we just got the answer of what that was going to break. It was going to break the banking system because deposits were leaving for higher yielding money market funds. Banks were stuck with these low yielding securities and just could not raise their deposit rates that much. And so deposits left. And so real problem, the Fed usually responds to interest rates. It's taken them a while to respond to the long-term interest rate. The 10-year Treasury yield peaked last October at 4.3%, and still the Fed's raising rates.